Managing foreign exchange in import and export. Introduction. For businesses involved in international trade, currency fluctuations can significantly impact profit margins. This volatile dance of currency pairs is especially pertinent to importers and exporters. A company's ability to effectively manage foreign exchange (FX) risk can be the difference between profit and loss on a transaction. Here, we'll delve into the intricacies of FX for import and export businesses and explore tools and strategies to navigate these waters. The impact of FX on import and export. For importers, a domestic currency appreciation makes foreign goods and services cheaper. Conversely, if the domestic currency depreciates, the cost of imported goods rises. For example, if a US company imports goods from Europe, a stronger dollar, USD, against the euro, EUR, means they'll pay less in USD for the same amount of goods. For exporters, a domestic currency depreciation can be beneficial as it makes their products cheaper for foreign buyers, potentially boosting sales. However, an appreciating domestic currency might make their goods more expensive, decreasing competitiveness in global markets. Strategies to manage FX risk. 1. Natural hedging. Businesses can naturally hedge FX risk by matching their currency revenues with their currency expenses. For instance, a US-based company exporting to the UK might also source some materials from there, thus balancing out its GBP earnings and expenses. 2. Diversification. By trading in multiple countries and dealing in various currencies, businesses can spread their FX risk. A loss incurred due to currency depreciation in one country could be offset by gains in another. Tools to navigate FX waters. Forward cover contracts. This is a commitment to buy or sell a currency at a specified exchange rate on a predetermined future date. By locking in an exchange rate, businesses can protect themselves from future currency fluctuations. This is especially useful for those with known future payment obligations or receivables in foreign currency. For instance, if a US exporter expects to receive EUR 1 million in 3 months, they can enter a forward contract to lock in the current EUR/USD rate. This ensures they know precisely how much they'll receive in USD, irrespective of where the actual market rate moves. Options. Foreign exchange options give businesses the right, but not the obligation, to exchange a currency at a predetermined rate on a specified future date. This tool offers more flexibility than forward contracts. It allows companies to benefit from favorable currency movements while still protecting against unfavorable ones. For instance, an importer fearing that a foreign currency might strengthen could purchase a call option on that currency. If the currency does strengthen, the option can be exercised at the predetermined rate, thus saving on costs. If it weakens, the option can be allowed to expire, and the business can benefit from the prevailing market rate. Conclusion. Navigating the tumultuous waters of foreign exchange is an imperative for import and export businesses. By understanding the mechanisms of FX and employing strategies and tools like forward contracts and options, businesses can not only protect their profit margins but also potentially enhance them. As with all financial instruments, it's essential to have a keen understanding and seek expert advice when venturing into FX risk management.